This week, CVS announced a 10% double-digit dividend increase. They are, however, down 22% year-to-date, trading towards their 52-week low with a yield of 3.41%. But are they a buy now? What will the intrinsic value calculator give us? Let's find out, and whether or not this is even a company worth having. Now, we'll also touch upon their dividend safety as well as some very important other financial metrics. But how has the performance been? Now, over the last 10 years, you would be up around 8% if you did hold this company. So very poor long-term performance. And we do see, to go to their all-time high, you have to go back to 2015, where it was around $113. Now, in terms of the company themselves, typically what we look for on the total revenue is around 3 to 7% growth year on year. And what we can see over the last 5 years, they have in fact nearly doubled their top line. Very, very strong. And on top of that, their trailing 12 months shows sign of another increase. So when we do get their annual report, it does look like we'll see some positive news. And on a more granular level, what I love to see are those consistent increases year on year. So to their top line, very, very positive. What does their bottom line net income show us? Well, a loss in 2018 of 594 million. Although we do see a very nice increase 5 years later to 4.41, it has been essentially a very inconsistent period. They did go from a net loss to an increase all the way to 21 before decreasing in 22, and then we see the trailing 12 months showing us a nice increase, in fact double what was December 22. So both top line and bottom line have increased over the last 5 years and are expected to continue to increase in 2023, but there were some inconsistencies. Now, a quick health check: total cash versus total debt. 6.6 billion in terms of cash and short-term investments in 2018. The latest quarterly report showing a significant increase to 16 billion, so they hold nearly 10 billion more than they did 5 years ago. And when we compare that numerically and directionally to their total debt, it has increased from 73 billion to 80 billion. So they do currently have a quite substantial total debt position, and we'll look to see how healthy that is. Now, we have some of their competitors in the healthcare industry, the Cigna Group, Laverty Corporation, as well as a few others. Now, year to date, including those dividends reinvested, they are in fact the worst performing, or one of the worst performing in the industry, down 19%. Now, over the last 5 years, when we take a look, we can see they are in fact up 10%. But realistically, over a 5-year period, you do want to be having your investments up more than 10%. But as we always say, past performance is never an indicator for the future. Now, institutional ownership sits at 76%, with around 9.8 billion worth of sales by these institutions over the last 12 months, but we note 12 billion buys over the same period, so institutions are buying more than they are selling. Although do note, over the last 2 quarters, Q3 and Q2, we do see more selling than buying by the institutions. So in more recent times, institutions aren't particularly in favour of CVS, but as a whole over the 12 months, we do see more buying than selling. Now, in terms of their earnings, and going back to the first 3 quarters of 2023, we see that CVS beat on both the earnings per share as well as the top line in Q1, Q2 and Q3. On top of that, when we compare their Q3 results 2023 versus Q3 2022, up 11% on revenue, up 166% on bottom line, up on the EPS as well as their net profit margin. So some very strong signs when we compare their Q3 23 versus their Q3 22. Now, Dividend Health 90 score, very safe, always good to see for any investment. 91 billion market cap, it is a large cap company. Now, in terms of recessionary metrics, for those that see a recession inbound, they increased the dividend during the 07-09 recession, negative 2.5% sales. But do bear in mind that that was above the average growth of companies in the S&P, which was negative to a larger degree, and they also outperformed the S&P with a negative 38% return versus the S&P's 55. Now, who doesn't love double digits? In fact, a very close 9.9% increase this month. Very good to see. Yes, the last 5 years it has been particularly slow at 2%, although the last 20 years shows that they are a company that does do very nice double-digit increases with 16% on average. Now, we can see, because they did pause that dividend for quite some years, that they have only been increasing that dividend for 1 year. Now, as always, dividend yield theory, undervalued if the current yield is above the 5-year average. So we do have our first sign of undervaluation, but remember we never look at these models in isolation. And when we take a look at the forward PE, another story or a very similar story with 8.6 below the 5-year average of 9.9, showing us another sign here of undervaluation. And the PE is significantly lower than the healthcare PE of 16.4. Now, in terms of the free cash flow payout, below 60%, personally, as it does give me faith that we will see double-digit increases. Very, very strong. I do love to see this. Yes, there were periods where they didn't increase their dividends, so do bear that in mind. But it has, in fact, been well below 40% even over that period, with 2022 at 21%, 2023 expected to be 27%, and 2024 at 34%. So that is very positive. It is what I like to see when looking at companies to invest in. Free cash flow per share, well, $3.12 in 2013, $10.30 in 2022, more than 3 times growth. It hasn't been consistent, but it still moves in the right direction, and it has been growing consistently, although do note 2023 is expected to come down slightly. Sales growth 3 to 7% is what I like to see, and interestingly, you may not see this from the numbers, but nearly double-digit increases every single year. Very strong period from 2014 to 16, a very strong year in 2019, as well as not only in 2022 11%, but 2023 expected to be around 10%. So that is what I quite like to see when we have strong double-digit inflation-beating increases to the top line. Total sales, if you are someone who likes to see the numbers, $127 billion in 2013 to $322. So again, nearly 3 times their top line over that period. Now, shares outstanding, personally, I like it when companies do share buybacks. It does return excess cash to our pockets. They did go through a period from 2013 to 2017 where they did that, although from 2017 to around 2019 they did the opposite and diluted your position by issuing shares. And over the period, we do see, in fact, the shares increasing by around 900 million from 2013 to 2022. So something just to bear in mind with this company. ROIC plus 10% or more, and what we do see in fact over the period, very inconsistent, a story of 2 halves, 2013 to 17 strong double digits, with 2018 to 2022 on the lower side, but it has picked up as we see, although 2023 is expected to be around 9%. Free cash flow margin, operating margin, very weak, especially for the consumer retails where we are looking for around 10% or more on the operating and 6 or more on the free cash flow. So do bear that in mind. Effectively, because they have a lower operating margin, it will squeeze their bottom line net income, which will essentially mean that those dividends that they do pay out will be smaller or in fact flat, as we did see for quite some years. And it does look like in 2023 on both of them, it does seem to be lower than the previous year. Net debt to EBITDA, now this will affect the dividend safety score. Below 3, which is the number of years it would take the company to pay off all of their debt net of cash on hand. 2022, 2.38, very strong to see. Below 3, hence why we have that very safe dividend score. Although note 2023 is expected to go higher, but still lower. So personally, I would like or would be happy with that 10% dividend increase and do see this dividend as very, very safe. Now, when we take a look at the valuation model, and as always, if you enjoy the content, values being provided, go ahead, smash the like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And if you do want to grab a copy of the valuation model to get your intrinsic value and acceptable buy price of companies in your own portfolio or watch list, do click on that pinned comment below. We have the first model, Graham's valuation, stock ticker, EPS, growth rate. We have the yield on AAA corporate bonds, gives us an intrinsic value of $74. Now, when we take a look effectively based on this model, we do see signs of reasonable or fair valuation on the market price. But do remember, we're not looking at any of these models in isolation and we'll draw our conclusions towards the end. Multiples valuation model, we have the ticker symbols of the companies that we did run through. We get their P multiple, we get their average, multiplied by the stock price of CVS to get, or the EPS, to get the stock price of $132. Now that shows some significant upside, just below 100% upside in fact, so we do have a sign now of severe undervaluation. Now we look at the dividend discount model. Now this is a bit mixed. Some years where it is relatively flat, followed by years of double-digit increases. So very inconsistent. Now average 6%. I've gone even lower. I do want to be more conservative, especially with an inconsistent company like CVS Health. As always though, if you do grab a copy of the model, you can play around with these numbers. DDM price coming out at $93. Slightly lower than the 52-week high, but again, showing some nice signs of undervaluation currently, even though it is up today on the back of that news, it is still showing signs of undervaluation. We then move on to the fourth model, DCF model, one of my favorites, free cash flow year on year, average growth rate 18%. Now I have tried to be more conservative as well on this model, so I've gone for 0%. With the discount rate of 8%, we get the present value of future free cash flow and terminal value. Add together with the cash, subtract total debt, get to the equity value. Divide by shares outstanding, so we have a DCF price of 115. Slightly higher in the 52-week range, some nice signs of upside, over 50% to the current trading price. So we have our fourth and final sign of undervaluation. Now, the valuation and intrinsic value is just the average of the models we have gone through. Now, personally, I have removed the multiples valuation. I don't believe it is fair to use any of these companies to compare versus CVS. I do believe they are slightly different, especially with their trajectory. And if you do go ahead and look at their numbers and their performance, I don't believe it is close to CVS to warrant to use this model. So the intrinsic value for this is essentially the three models, and it comes to $94. So it is the average of these three. Current price around $71, although when we take a look, it is up now to around $73, so it is increasing after market open. Margin of safety, always 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. Now, for those that believe a higher margin of safety, at 15%, it is a buy up to $80, and at 20%, it is a buy up to $75, and if we push this to 25%, it's not a buy, so you have to wait to $70. So what we're saying, based on our estimates and judgments, you are getting a 20% margin of safety on CVS. And what Wall Street believe? Well, over the next 12 months, they believe the share price to go up quite high, slightly lower than our intrinsic value, but they do see some nice upside, around $15 per share, so 20% upside. So in conclusion, with CVS, you are locking in a 20% margin of safety based on what we believe, with a 20% upside per Wall Street forecast over the next 12 months. As always, if you enjoy the content, do smash that like button, hit the subscribe and bell so you'll continue notified of these videos as they drop. And if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, grab a copy and click on that pinned comment. As always, have a great day and catch you all on the next episode. Take care.